Hello, dear listeners, and welcome back to Book Summary 5, the 5-Minute Summary channel. I'm Sammy, your host. Today, we're diving into Security Analysis by Benjamin Graham and David Dodd. Originally published in 1934, during the depths of the Great Depression, this foundational text is often regarded as the Bible of value investing. It laid the intellectual groundwork for generations of investors, including Warren Buffett, who studied under Graham and often quotes lessons from this very book. It's dense, technical, and not exactly a beach read, but within its pages lies a disciplined way of thinking about risk, reward, and what truly makes a stock or a bond worth owning. Graham and Dodd begin by distinguishing between investment and speculation. To them, an investment is something you understand and can justify based on solid analysis. It offers safety of principle and an adequate return. Anything else? That's speculation. They argue that far too many people confuse the two, buying into hype or trends without a real grasp of the underlying value. This book aims to equip readers with the tools to analyze securities carefully and rationally. Much of security analysis focuses on reading between the lines of financial statements, unpacking what earnings, assets, liabilities, and dividends really tell us about a company. Graham and Dodd emphasize the importance of intrinsic value, the true worth of a company based on its fundamentals, and how that intrinsic value may differ wildly from what the stock market currently prices it at. Their strategy? By when a stock is trading for less than what it's truly worth. That difference, what they call the margin of safety, is a buffer against uncertainty and misjudgment. It's the heart of value investing. They devote extensive attention to analyzing different types of securities, including bonds, preferred stocks, and common stocks. In each case, the core idea is to understand the earning power and asset backing of the business. With bonds, for example, the safety of principal is paramount, so the authors focus on coverage ratios and creditworthiness. With common stocks, they look at earnings stability, dividend history, and the company's future prospects. But always with skepticism. For Graham and Dodd, numbers need context. A high earnings figure may look great until you realize it's built on unsustainable trends or accounting gimmicks. Another key message throughout the book is discipline. Graham and Dodd weren't trying to beat the market by making bold predictions. They were trying to avoid losses through methodical, conservative judgment. They encourage readers to focus not on market trends or short-term fluctuations, but on long-term business realities. That means digging deep into balance sheets, income statements, and industry conditions. It also means avoiding the trap of overconfidence or emotional investing. Numbers must guide you, not stories or sentiment. They also argue that markets are not always efficient. Prices are often driven by human psychology, which means they can be irrational, overly pessimistic, or euphoric. The intelligent investor sees this not as a problem, but as an opportunity. If the market undervalues a solid company, that's your chance. If it's wildly overpricing a popular stock, it's your signal to walk away. Graham and Dodd want you to treat the market like a moody business partner, one who sometimes offers you bargains and sometimes tries to sell you nonsense. Your job is to recognize the difference. The book also introduces the concept of market cycles. Graham and Dodd were writing in the aftermath of the 1929 crash, and they understood how easily euphoria can turn to despair. Their approach prepares investors to weather these storms, not by predicting them, but by always staying anchored to value. If you invest with a margin of safety, you can survive downturns and thrive in upswings. This long-term mindset is what separates true investors from gamblers. Perhaps most importantly, security analysis is not about chasing flashy returns. It's about preserving capital and growing it slowly, steadily, and wisely. Graham and Dodd emphasize that real wealth building comes from compounding, not speculation. And compounding only works if you don't take unnecessary risks that wipe you out along the way. So while the book is rich with technical detail, discounted cash flows, earnings multipliers, asset-based valuations, its philosophy is actually very clear. Be patient. Be thorough. Be rational. Buy businesses, not stories. And always leave yourself a cushion in case things don't go as planned. Security analysis remains one of the most respected texts in all of finance, not because it offers shortcuts, but because it teaches the kind of mindset that lasts. In a world of fast trades and flashing screens, it reminds us that true investing is about thoughtfulness, diligence, and staying calm in the face of noise. Thank you for tuning in to Book Summary 5, the 5-Minute Summary channel. If you enjoyed this timeless dive into the foundations of value investing, please subscribe, like, and share it with your friends. Until next time, happy reading, and may your investments be sound and your patience strong.